Welcome back to Wichita Liberty TV. I'm Bob Weeks. Last week I attended a conference produced by the Franklin Center for Government and Public Integrity. We met in Alexandria, Virginia at a very nice hotel where I had stayed there also last December. At that time, the maid noticed I left an empty Diet Coke bottle in the trash. And at the end of the day, when I returned to my room, there was a can of Diet Coke on the desk along with a note that said, "Dear Mr. Weeks, please enjoy this Diet Coke." So this trip I brought along with me an empty bottle of fine old single malt Scotch whiskey. Well, no, I didn't really do that, but I thought about it. At the conference, we had a number of very useful briefings. One was presented by Jim Pinkerton, the journalist, Fox News contributor, and co-founder of the RATE Coalition. That stands for Reforming America's Taxes Equitably. In his briefing, he referred to the economist Frederick Hayek and told us that the purpose of high taxes on the rich is not to get the rich to pay money, it's to get the middle class to feel better about paying high taxes. Well, others have also noted that changes to marginal tax rates often have little impact on the amount of taxes actually paid. The top marginal tax rate, that's the rate that applies to high-income earners on most of their income, was above 90% during most of the decade of the 1950s. From 2003 to 2012, it was 35%. It's now been raised to 39.6%. The top marginal rate is the rate that applies to income, and it's not the same as what is actually paid. And this fact is unknown or ignored by those who clamor for higher taxes on the rich. They often cite the rising prosperity of the 1950s as caused by the high marginal tax rate, over 90%, remember, in effect at the time. Well, the mistake the progressives make is equating tax rates with the tax actually paid. Now, for many people, there's a direct relationship. For workers who earn a paycheck, there's really not much they can do to change the timing of their income, find tax shelters, or shift income to capital gains. When income tax rates rise, they generally have to pay more. But rich people can use these and other strategies to reduce the taxes they pay. But as Pinkerton told the conference attendees, the high tax rates make the middle class feel better about paying their own taxes. They may take comfort in the fact that someone else is worse off, at least based on the misconception that high tax rates mean rich people actually pay correspondingly higher tax, at least when considering tax rates. Well, I gathered data from the Bureau of Economic Analysis, that's part of the United States Department of Commerce, and along with my calculations, I made a series of charts. In this chart, you can see that the top line, which is the top marginal tax rate in effect for each year, that's varied widely. The other two lines show total taxes and total federal income taxes as a percent of gross domestic product. And as you can see, since World War II, these lines are fairly constant and level, even as the top marginal tax rate has varied widely. And then using data from the Internal Revenue Service and the Congressional Budget Office, I developed two other charts. One shows the share of total federal taxes paid by top income earners, in this case the top 5% and the top 1%. And for the range of years for which the CBO provides data, you can see the top marginal income tax rate again varies widely, mostly in a falling direction, and the share of federal income taxes paid by top earners has risen slightly. And a second chart shows the average federal tax rate for these two groups of top earners, and we can see that the average federal tax rate paid by them has varied much less than has the tax rates. Now, this may be surprising to you, that tax rates can vary widely, but the taxes actually paid, at least by top income earners, doesn't change very much. This is an example of people reacting to incentives in ways that policymakers don't anticipate. Well, a second speaker at the conference was the economist Stephen Moore, who recently left the Wall Street Journal editorial board to become chief economist at Heritage Foundation. And a large portion of his presentation was on energy and its important role in the economy, and how radical environmentalists, the green movement, are hurting our economy and people. An irony, he said, is that while President Barack Obama is in the hip pocket of radical environmentalists, he is presiding over the greatest oil and gas boom in American history. And this boom is proceeding in spite of government, not because of it. Well, Moore emphasized the importance of energy costs to low-income people. Rising energy costs are like taxes on them, he said, while the wealthy can more easily absorb higher energy costs. He told the audience to be green is to be against capitalism, against progress, against poor people, and against jobs. He also told the attendees that the boom in oil and gas production in America, made possible by horizontal drilling and fracking, is ahead of the rest of the world. And while European countries have in the past embraced green energy technologies, these policies have largely failed, and the countries are retreating from them. Now, European countries want to use American drilling technologies, he said. And the lower electricity prices in America are a competitive advantage over Europe and China. German auto manufacturers, for example, are shutting down plants in Europe and moving them to the United States. And of the radical environmental groups, Steve Moore told the audience, they don't even care about global warming. If they really cared about global warming, they would be cheerleading fracking, because fracking is making natural gas the new fuel for America. And guess what? Natural gas emits less carbon. It's a great antidote to global warming. That's the end of his quote. Well, I looked it up. According to the U.S. Energy Information Administration, when generating electricity, coal emits from 2.08 to 2.18 pounds of carbon dioxide per kilowatt-hour electricity generated. Natural gas emits just 1.22 pounds, or about 43% less carbon dioxide. Well, Moore went on to tell us that it is the United States that has reduced its carbon emissions the greatest amount in the last 5 years. He said this is remarkable in light of the fact that the U.S. didn't sign the Kyoto Treaty, the U.S. did not implement cap and trade, and also the U.S. did not implement a carbon tax. And he said you'd think that these environmental groups would be applauding natural gas. Now these environmentalist groups have a new campaign called Beyond Natural Gas. He said that at first, environmentalists said they could accept in natural gas as a bridge fuel to solar power and wind. They were in favor of natural gas, he said, well, up until the time it became cheap and plentiful. Now they are against gas. My point is, he said, the left and environmentalists are against any energy source that really works. Over the past 6 years, he told us that the United States has spent $100 billion promoting wind and solar power, but together these two sources account just for 2.2% of the electricity generated in America. Even if the country were to quadruple the portion of electricity generated by these two renewable sources over the next 10 to 20 years, the nation would still need to get 90% of its electricity from other sources. And Moore thought this was doubtful that the country could achieve those goals. Well, to further investigate the topics Moore raised, I gathered data from the Global Carbon Atlas and prepared interactive visualizations using Tableau Public. You can use these visualizations at wichitaliberty.org, but here are some findings I'll share with you. If we look at the chart of total carbon emissions, we see two important facts. First, after rising slowly, carbon emissions by the United States have declined in recent years. Second, carbon emissions by China are soaring. China surpassed the United States around 2005, and the gap between the two countries is increasing. Note also that carbon emissions in India are rising. Emissions in the most advanced economies, that's us and Europe, and mostly in Canada, are steady or falling. And these trends are emphasized in the chart that shows carbon emissions for each country indexed from a common starting point. Emissions from China and India are rapidly rising, while emissions from countries with advanced economies have risen slowly or have declined. Well, a chart that shows carbon emissions efficiency of countries, that is, the carbon emitted per unit of gross domestic product, shows that in general, countries are becoming more efficient. Advanced economies such as the United States, Japan, and Germany have an advantage in this metric. These countries emit about 1/4 as much carbon per unit GDP as does China. And the chart of carbon emissions per person in each country shows that the United States leads in this measure. In 2011, the U.S. emitted about 17 tons of carbon dioxide per person. China was at 6.6 and India at 1.7. But the trend in the United States is downwards, that is, less carbon emitted per person. In China and India, the trend is up and rising very rapidly in China. Well, so what does all this mean? Well, the rapid rise of carbon emissions from China and India dwarfs anything that the United States and other developed economies can do to reduce carbon emissions. When radical environmentalists ask you to spend more on electricity or gasoline, or to pay higher taxes in the name of global warming, remember that anything we can do in America to reduce carbon emissions is insignificant on the global stage. Well, thank you for watching this episode of Wichita Liberty TV. I'm Bob Weeks.